Hi, this is Randy Finney with the Right Side of the Chart, and today is Thursday, December 20th, 2012. And in this video, I'd like to do an overview of several key indices and as well as some sectors. I'll go through these in no particular order, but what I will do in this video, which is different from most, is focus only on the weekly time frame. I'm not going to zoom down to the daily or go out to the monthly time frames like I usually do. In trading, as I always state, it is important to continually monitor all time frames. I know a lot of rookie traders can make the mistake of getting caught up only in the daily charts, sometimes in the intraday charts, and it's very important how they all tie together. One example might be going long on a breakout on a shorter term time frame, not realizing there's a key resistance level overhead, and therefore the weekly charts, in my opinion, take precedence over the shorter term charts. But again, they're all used in conjunction. Well, anyways, with all that being said, let's take a look here at some of the weekly time frames, and we're starting out looking at the XLK, which is the SPDR Select Technology ETF. And these charts, keep in mind, this is a watch list that I follow. Normally when I post charts on the site or when I do these videos, I'll have these charts cleaned up. So bear with me, a lot of these charts might seem a little busy. There are a lot of things that I will normally leave up on the charts that I follow. And when posting those charts on the site, in order to make it a little bit clear for everybody, I'll sometimes turn off or hide some of these indicators. But trend lines, Fibonacci retracements, things like that. So when we're looking at here on the XLK, and again, technology being a key sector in the markets, I had multiple trend lines. As you can see, this was the first trend line off the 2009 lows, beginning of the bull market, which broke back here in May of 2011, broke down, retest, and from that point, from the end of that sell-off, I've since been tracking this new primary uptrend line. As you can see, quite a few touches, pretty well defined, and we recently had the breakdown of that key trend line. And so far, we've had nothing but a bounce back. We hit this key support level here, as you can see if you just follow this to the left. Quite a few price reactions, and prices have come back up, but they're still well below this trend line. In fact, technology hasn't even been able to make a retest of that key trend line like a lot of the key indices have. So there's the XLK. Moving on to the XLP, SPDR Select Consumer Staples ETF. What we're looking at here is defined by these orange trend lines, more of a rising wedge type pattern that I've started off this level back here on the lows in 2011. And as you can see from the RSI and MACD below, very clear, like many of the weekly charts, things that I've been pointing out for months now, very solid, unmistakable negative divergences in place on the recent highs. With the XLP, we had a breakdown, and at this point, nothing but a retest. Interesting to note as I'm looking here, I've had these Fibonacci retracements on this for years, since the last here. This was the top of the last bull market, these two peaks back here in 07 and 08, so that was the full move down. And interesting how we hit, which is a key Fibonacci number, the 161.8 retracement is where this move stopped. So of course the XLP has been very strong, by far exceeding its previous bull market highs, but again, coincidental or not, that's where prices stopped, broke this pretty very well defined rising wedge, negative divergences in place, has since made a retest. And overall, I'll try to comment on each of these charts at the end. My take on this: that is a bearish looking chart. Typically after a wedge breakdown, if you do get a retest, which is common, prices will then turn lower and continue lower. And as I've talked about a lot in the past, it is these divergences that in many cases go for a year or two, sometimes more, that tell me that there's more than likely more downside than we've already seen on these wedge breakdowns. So that's the XLP. GLD, I've posted a static chart on the site recently. GLD is, as I mentioned, has been the longest standing short trade that I've had on the site. It's been on for most of the year and still positive, not by a whole lot. Way back when we hit the first target, which was, we shorted it here on this retest of this yellow line and covered when at the bottom of this channel. So what I've been watching for well over a year now, these blue rising trend lines form a nice channel. Yes, we had a little brief break below the channel back here, but other than that, it's a pretty clean ascending channel, and prices for months now have been skating along the bottom of that channel. We had a move back up here, which way back when, that's what I stated my stop criteria on this the recent short trade would be, and we stopped right at that line and turned back down. So the trade's still intact, and I'm doing this video right now. It's about 15 minutes until the close. It's 3:45 Eastern time, and we have a very clear, solid breakdown so far. And being that this is a weekly chart, unless gold can really turn around and do a heck of a rally tomorrow and get back up above that trend line, we're going to get a weekly close, which is what I want to see to confirm. Since we're looking at a weekly chart, my criteria for a breakdown on that channel would be a weekly close below, not an intra week. In other words, if one day, we've had quite a few days where prices pierce below but then close back above. So that's what we're looking at gold, and this has been the long-standing second target, this line here, T2. I did add this line actually since I posted that static chart yesterday, and I might move my second target up to this level because I do see some good, pretty decent horizontal support, and that is for you gold bugs or those of you who might want to short it, 147.50-ish we'll call it, and I might make this the third target, and we'll see. I'll revisit gold later and do some static charts on that possibly over the weekend. By the way, silver is also looking very bearish, having a bad day today. UUP, this is the US dollar ETF. Overall, bearish looking, bearish for the dollar, that is. And here's the previous reaction lows back here. So the dollar needs to hold this level. If it breaks below this orange line, that is the next support level. We could see some additional downside. Typically a falling dollar is bullish for stocks, although there have been times over the years where that relationship has been broken. So we'll have to see what happens going forward. So not a whole lot to say on the dollar other than it doesn't look so hot. IYT, this is the transportation ETF, and we've had this recent very bullish breakout here. There's been this well-defined downtrend line, this symmetrical, almost symmetrical triangle pattern here defined by these two lines, and the transports have broken up, and the buying's been pretty impulsive since then. We are coming up, if I zoom in here, this horizontal line which marks the previous reaction highs. That will be our next resistance level, and of course above that we have these 2011, early 2011 highs to get through. So either way, IYT is coming up on resistance here, and I would expect at the very least a reaction off this level. Reaction being prices pause and consolidate, or more likely a little bit of a pullback. So for those more nimble traders, and of course you'd want to use the daily and 60-minute charts to do this, you might want to take a look at some of the transports now that are a little bit overbought in the short term, for those looking for a quick pullback trade, or maybe some longs that want to take some profits on those. So overall, all in all, for now, that is a bullish event on the IYT on the weekly time frame. TLT, I have posted some static charts on this recently. We have this rising wedge pattern. Prices broke down, pushed back up, retested, and recently the selling off that retest, the move down has been very impulsive. Clear negative divergences in place. So according to this chart, treasuries, at least treasury prices, look bearish. That means rates up, prices down. The TLT is the iShares Barclays 20-plus year Treasury bond fund, so that holds anything that's 20 years or over. So you'd want to look at the TYX as the 30-year Treasury Yield Index. So that's pretty much the inverse of this. And I did put that static chart up on the site recently. Something else to note here are these Fibonacci time zones. It started off on this peak. I've had these up for a while too, and as you can see, looking at the levels here, they've marked some clear inflection points. Prices turned, and this one fell down sharply, made a sharp reversal up here. And although this was sort of a continuation, there's a fib level that lined up here, and prices shot up at that point. So it wasn't a pivot or a reversal, but it was a pretty important point. And look how nicely that next one came and marked the highs recently there. And so far those have been the highs on the TLT. So bonds are looking bearish as far as prices go. QQQ, I've talked quite a bit about this lately. These charts have been all over the site. Like a lot of the other indices we looked at, we had these original trend lines off the 2009 lows, broken, retested, prices fell back, and this is now the new primary key uptrend line that we're watching. And recently, as I've highlighted, prices have broken below that, and we had some very impulsive selling to take us below. Hit my third target on the daily chart almost to the penny and put in a reversal there. And the Qs, as I've pointed out, mainly because of Apple, have been lagging the bounce. The S&P 500 has been stronger on the bounce, as have most other sectors. And QQQs continue to lag and haven't even been able to mount a full retest on that trend line yet. Again, negative divergences were in place on the recent highs. If you look at the peak to peak here, marked by this yellow line, versus these MACD and RSI lower highs, that is clear negative divergence. And we did have that play out, and again, as spent a lot of time on this, I do think there's additional downside to come over time. IWM, my apologies, this chart is very busy. What you're looking at here, like the other index charts that I covered, we have a primary uptrend line that's highlighted in white right here. That primary uptrend line off the bear market lows back in March 2009, those held all the way up until late 2011, or May, I think it was May 2011, broke down. And what we're looking at here, these yellow lines, there's one here, one here, one here, and one here. These are Fibonacci fan lines. And what I found interesting is I had this trend line that I've added. It picks up the 2009 low, this peak low back here in 2011, and then the more recent low. And this was the original uptrend line I have. When I place these Fibonacci fan lines off the lows here, they line up perfectly. There's one right on this trend line that I had drawn before, and one on this trend line. And so it also added these other two in here. And as you can see here with the IWM, once we broke that first trend line and fan line, prices pushed back up for a retest, fell back, caught support on the next fib fan line, bounced up, broke below, and tagged the next fan line perfectly, in a sense moved higher, and look, we've danced and again recently come back and kissed that trend line again, both the uptrend line and the Fibonacci fan line, and that's something to watch for. I think if we do break this fan line here and this uptrend line, odds are this next fan line would be the next support level. So we'll see where that comes in. And I'll talk a little bit more on the IWM. I'll cover the Russell 2000 here in a minute. That chart's not as busy looking as this one. The SPY, another busy chart, but same story. Uptrend line here that I've had drawn for a long time. That was broken, and I did add these Fibonacci fan lines as well. And as you can see, prices seem to really play off these well. We broke the first key uptrend line, which was where I started the Fibonacci fan lines, and came back, hit that level, and have danced upon it, and recently broke below it, and we are now retesting it. And again, these charts, I'll try to zoom in here. The yellow lines are the fib fans, and my apologies because there are a lot of trend lines on here, and I've showed these charts in different forms over time, so you may just want to revisit some of the charts on the site by clicking on the symbol. If you click on SPY/SPX, it'll bring you all the charts on the SPY and the XPX S&P 500 that I posted. So that's where we're all. I'll talk a little more on the SPX when we get there. I believe that chart's a little cleaner. Here's the IYR, iShares Dow Jones US Real Estate Index Fund. The IYR tracks the DJUSRE, if memory serves me correct, the Dow Jones US Real Estate Index. And so what we're looking at here, rising wedge pattern. You can see the MACD and the RSI are diverging and have been for a while, and we recently had prices break below that key uptrend line off the 2009 lows. So all in all, a bearish, longer-term bearish looking chart. MUB, I did post this one recently on the site just in the last day or two. See iShares S&P National Municipal Bond ETF. These are trend lines, as you can see, that have broken in the past, and we most recently had this pretty clean uptrend line break that goes all the way back pretty much throughout the beginning of the year. This is March 2012, and you can see that impulsive selling. This is the next target that I have on the downside. Also note that the red line here is the 200-day exponential moving average, which is also the 40-week moving average, because we're on a weekly chart here. And you can see how that line has also acted as support for quite a while now, even going back to this point in time here. So you can see prices have tried to get back up there. Nice hammer, but yet we're right below that 200 EMA or 40-week EMA, as well as the trend line. So all in all, muni bonds are looking bearish, which means rates up, prices down. Gas, that's a ETF I had in here. I won't talk much on that. A lot of these ETFs and ETNs, especially those that track futures like gas, which is the natural gas ETF or ETN, they don't track that well. But then again, you can see here that is a pretty key support area under the 280-ish level. Keep an eye on that. I don't have any positions on that and haven't had it on the site for a while. Euro versus the US dollar. The euro has been bullish lately, as I mentioned a minute ago, looking at the dollar chart, the UUP, which looked more bearish. We've had quite a few trend line breaks. These aren't Fibonacci fans. These are just trend lines that I've had drawn in the past. Again, we're looking at weekly charts here. We've had one breakout after another breakout, another breakout, and we recently, if going back to the highs here in the euro US dollar all the way back in May of 2011, this is the most recent trend line I'm watching, and we've had this breakout, so something to watch there. Euro's looking bullish lately. RMZ, this is another REIT index. As I mentioned a minute ago, the IYR tracks the Dow Jones US Real Estate Index, but another popular REIT index is the RMZ. And again, very similar. Obviously, it's tracking the same sector, just made different basket of stocks, some different components. And you can see this uptrend line off the 2009 lows has been broken. You can also see prices are still hanging around the 61.8 fib retracement from the entire move down from the bull market highs back in 07 to the 2009 lows. So that's where we're at with the REIT. So all in all, a bearish chart because we have broken this key uptrend line, and I just don't see anything much else to cover on that. Maybe some resistance here if we do push back up. This previous reaction high right here around the 950 level would be the first resistance point if prices continue to push higher. And a retest, if you are short that sector, would be quite painful. I actually do have a small short position in the REIT sector right now. XAL, this is the Amex Airline Index. Looks like a very bullish breakout. As you know, airlines love low oil prices, and that's what we've had recently. And here's a nice symmetrical triangle pattern which broke to the upside, and there's been some strong and impulsive buying, and that sector is now coming up to the first resistance level, this horizontal line, which goes back to these previous reaction highs, as well as some reaction lows back here. back in the last bull market. So that's something I might take a look at soon. I imagine if we zoomed in on the daily and maybe 60-minute time frames, we'd see some of these airline stocks looking quite a bit extended right now and maybe ripe for a pullback. So that's something I'll try to take a look at here in the next few days. But overall, that chart, by the way, was that's a bullish event, that breakout there, that symmetrical triangle. So Dow Jones US Semiconductor Index. This is an interesting chart. Clean pattern here, and we've had this breakdown back in October, late September, early October, and so far prices are making a perfect retest. They actually retested that line already. If you zoom in, you can see that candlestick kiss right there, the wick on the top of that candlestick, and prices pulled back a little. So all in all, semis look bearish, and again, semis are a key component of the market, both the S&P and of course of the nasdaq. Right now we just have a breakdown and a retest, and I would expect prices to go lower. However, if they do regain this trend line, of course that would be a bullish event. DXYO, that's the dollar. We've already talked on the dollar quite a bit. Here's the NDXE. This is a NASDAQ 100 equal weighted index. Again, a chart I've covered a lot in the past few months. Rising wedge pattern. This is a pretty clean and simple chart, folks. If you just look at the yellow lines, yellow trend lines, clear negative divergence in place on the RSI and the MACD. In fact, we have double divergence. If I were to add another trend line down here, you can see the MACD is lagging right here. I could add that. Oops. There we go. That divergence. If prices come up now, to have negative divergence, we have to have prices make a higher high, or at least peak out with an equal high, and we're almost there right now. So something to watch. But longer term, again, this wedge pattern with negative divergences in place, and this pattern has not broken down. We almost had a breakout here, but it looked like a stick save back at the lows, in the week of November 16th. So something I'm looking for. Now, if we bust out, as I've talked about a lot, divergences can be burned through. So look at the RSI, we're right up against that trend line. The MACD still has a way to go as far as this yellow trend line here. But if prices were to take out these old highs, keep going up, and again, taken in conjunction with the daily charts, what we see happen there, as well as the monthly charts, this bearish look, the bearish technicals here could eventually be negated. But for now, my opinion has not changed one bit in the last few months. Longer term, this looks bearish to me, and I would expect a breakdown and a move lower over time. Here's the NASDAQ composite. So all the components of the NASDAQ here, 2009 lows, couple trend lines, just like the other indices that we covered earlier. Breakdown, retest of this first uptrend line, and since we have formed this yellow uptrend line, which is very well defined, lots of touches going back, from the lows in 09. And I had these other trend lines. If you look at these white trend lines here, that's a rising wedge pattern. And either way, both of those have been broken down. Prices have pushed back up and coming very close to retesting this yellow primary uptrend line off the 2009 lows. So we're almost at a retest. Prices are still below this recent, we had this breakout. I talked a lot about these bull traps, these breakouts to new highs, which failed. Prices fell back below. And, just looking at this chart, if we were to go up again and challenge these old highs here on the NASDAQ, not old highs, this, I should say, resistance level of about 31.35, back where we peaked here, looks like a nice little head and shoulders pattern with a left shoulder here, head. If this continues to come up, maybe retest, rides this trend line up a little bit and then turns back down, that would put in a right shoulder. This would be your neckline here, and that would project quite a bit lower. So something to watch. Overall, because of the divergences in place, I believe this chart is still looks bearish longer term. XRT, SPDRS Retail ETF, pretty clear trend line. and prices are still above it. So until, support is support until support is support until broken, as I like to say. And again, we're seeing, like everything else, and remember, these are weekly time frames, so these are multi-week, month, or even in some cases multi-year divergences in place here. And from my experience, when you see divergences like this, negative divergences on a weekly chart, especially on an extended bull run, we're almost 4 years into this bull market, and when you get divergences like this, it's usually only a matter of time before they play out. So, at this point, the chart looks bearish to me, but there's not any confirmation. We haven't had a breakdown here yet in XRT, but that is a sector. If we do break below this trend line, that's something I'll be digging into, looking for some individual shorts. JJC, this is the copper total return index. This isn't the price of copper. This has a lot of the components in the copper industry. And we could take a look at those. I won't do that now. So this is an important uptrend line here, going back all the way from October of last year, October 11, and prices now are getting close to the bottom of this trend line. So keep an eye on this orange trend line. We recently had some bullish action. Here's a downtrend line, this white downtrend line. Prices broke above that, came back, and recently retested. So you can look at this like many things right now, glass half empty or half full. Those looking at the glass half full see a bullish breakout and a retest, and prices are still above that level, although we had some pretty impulsive selling here recently, or this week, if you look at that candlestick. So keep an eye on this level as long as prices remain above this uptrend line. Overall, this is a bullish chart. If we break below that uptrend line, bearish, and again, we'd have to take it in context with everything else. Next chart is the S&P 500 equal weighted index. Had a couple trend lines drawn here off the lows. This was the first uptrend line. Prices broke down below this key primary uptrend line, which is really the one I would favor. Just looking at, what I pay attention to are the highest number of candlestick wicks, tails, or body touches. Trend line drawing, in my opinion, is an art, not a science. And yes, we do have this candlestick wick here that was on a some quick overthrow, a little overreaction in the market, but yet it is something to note. So I have this uptrend line here drawn as well. So prices punched below this one and have regained. We have this divergence in place here. If you look at this yellow line, compare that to the MACD and the RSI, that is a long-standing powerful divergence going all the way back to April, early May of 2011. Prices making a series of higher highs here on the S&P equal weighted index, with the MACD and the RSI making a series of lower lows. These divergences aren't even, well, they're getting close, but they're not yet at risk of being taken out, being negated. Something to watch, of course. So we'd need, prices have to punch up quite a bit, somewhere up to this level, before undoing a lot of the bearishness that I see in these charts. Investment brokers, this is a sector I was quite a bit worried about earlier this year. It was looking very bearish, and if it gets back down to this critical support level here, as I talked about, there's virtually or literally no support underneath this support line, and prices were dancing on that level earlier in the year. But as you can see here, I've added this downtrend line, and prices recently broke above it, which is bullish. So near term, that's a bullish event. We do have at the horizontal line here quite a few reactions back here, the recent peak high, and so far, as you can see this week, we're right about on that line. This is a weekly candlestick chart. We'll have to wait for a close tomorrow to see where we're at, so something to keep an eye on. But if prices continue to power higher and put this line in the rearview mirror, this, of course, this prior reaction high over here would be the next resistance. But until then, that's looking overall bullish. Railroads, Dow Jones U.S. Railroad Index. if the chart ever loads here. Okay, here we go. Alright, this is a chart I've followed for a while. As you can see, most recently we have this rising wedge pattern here. Clean breakdown, retest, and that's where we're at now. So definitely a bearish chart in my opinion, longer term. Like everything else, the market's had a pretty sharp correction, which could end up being wave 1 down of a new 5-wave primary downtrend, and this being the wave 2 up, just like in the broad markets, which I believe there's a good chance it is right now. So overall bearish, especially when considering these longer term divergences. You can take this trend line. I had the wedge drawn this way, but the divergence actually goes back to this point, so you can draw that either way you want. But the story is the same. Quite a bit of divergence there. This was the first uptrend line off the 2009 lows. These pink lines were just the wedge projections. You take the widest part of the wedge, like I did back here, and duplicate this line, and that's what I did. I added that, and this was a short earlier in the year, I believe, and came right down perfectly to our first target. That's technical analysis. Sometimes these charts play out almost to the T. More often than not. It's very interesting. So either way, if we turn back down now, this chart does look bearish to me. I think we'd at least revisit T1, and more than likely, before all is said and done, go down to T2. If you look over here at the volume at price histogram, once we get below this level here, so the recent lows, and follow the, let me turn that off here, follow the horizontal line, and you see down here it's thin. Look at the crosshairs. Not a lot of trades in that area, so I think we'd quickly come down if there's some, and definitely if there's a wave 3 down to come. Wave 3s are usually the most powerful, and that would probably take us somewhere down to that T1 area again, maybe close to it, and eventually get another bounce and move down to T2. XLB, basic materials, overall bullish chart. Can't say otherwise. We had this symmetrical triangle here. Prices recently broke out where you see this circle, pulled back, did a retest of that downtrend line. Let's get rid of this circle. Did a retest, a hair below it, but it saved the day, came up, and prices have since turned back up. So basic materials overall, that's a bullish looking chart to me. Here's some resistance around this level, as well as a little bit higher at the previous reaction high, something to watch for. So we are, as I go through these charts, there is a mixed bag of bullish and bearish charts. XLU, utilities, nice clean, sort of contracting channel, we'll call this. I wouldn't call it a wedge pattern. You could call it that if you want. The downtrend line is pretty well defined by these long tails on these candles, and recently we hit that downtrend line again, so that makes it 1, 2, 3, 4 touches on that trend line. This was a key level here where I'm holding the cursor. It's lighting up this orange horizontal resistance line that I have. That's also the 61.8 fib. If you look to the left of the screen here, I have the fibs, which mark the move down from the last bear market, from the 2007-2008 highs all the way down to the lows in 2009. And interesting how we did briefly take out what was both horizontal resistance as well as a 61.8 fib, and that turned out to be a bull trap, like so many other things, so many other key indices and sectors that I covered recently. Prices punched above there, came back down, should have held. A bullish move to see that level, that fib and the horizontal resistance breaking out. You would see a breakout, come back, prices come back to retest, and then to power back up. But to see it fall back below that level, that's an extremely bearish event in my opinion, like we saw in a lot of the indices. Take a look at the red line as well, the 40-week exponential moving average. Not done a perfect job, but a pretty good job of defining this uptrend. And now, as you can see, that 40-week moving average has turned down, and prices are also right at or below that level. So key level right here on the XLU. Prices can get above this once again and continue to move higher and get back above this 40-week moving average. It's looking good. Come down here and take a look at the MACD. This I noticed this on a lot of charts on weekly time frames, sometimes on the dailies. But the MACD, the posturing of the MACD can often define uptrends and downtrends. I put this orange horizontal line at the 0 level, and typically when your MACD is above the 0 line, I mean that's the bullish stance on the MACD, and as you can see, prices are moving up, and when prices cross below that level, that's typically when you're in a bear market. And again, we're looking at a weekly time frame, so that's looking at the MACD. So since going back to early in the bull market, the MACD has moved above and pretty much managed to stay above that level. And if you note here, we are now starting to break below that level. In fact, the 0 line is the dotted line as I zoom in here, so you can see the MACD is below that level. So all in all, because of the bull trap and the fake out and the fact we have key resistance overhead and the MACD as I talked about, that is an overall bearish chart in my opinion. Semiconductors, this is the SMH, the HOLDRS Semiconductor ETF. As you can see here, it looks like a possible upsloping head and shoulders pattern with a left shoulder, head, and a right shoulder. This would be your neckline, something to watch out for. You also have, as defined by these orange lines, a key downtrend line going all the way back to 2004, early 2004. Very obviously a very bullish event if prices can break above this level, and this was the downtrend line off the 2009 lows, which we recently broke above. Prices have just gotten back up inside there. If we can stay up in there for another week or so, I'll have to put this chart as more neutral to slightly bullish, the fact that it did regain this line. But let's see if we can hold that. Let's see what the next week brings here. Either way, something to watch because we're coming to apex here on these orange lines. So something to keep an eye on. USO, there's oil. So we know oil hasn't done a whole lot. Airlines have been doing great because oil has been prices have been coming down. It looks like some support levels here on USO. XLE, the energy sector, obviously tied in with USO tightly. USO tracks crude prices. And here's a nice triangle pattern. XLE can take out this downtrend line. That would be a bullish event. And if it falls below this key uptrend line, which goes back quite a ways, I think even further off this chart, that would be a bearish event. And finally, these are some support levels below to keep an eye on XLE. This is a pretty key one right here, this horizontal line. Okay, this video is getting a little long, so I'll finish up quickly here. This is XLF, the financial ETF, very important sector. Very, very solid resistance. XLF has been strong lately, no doubt about that. In fact, there's quite a few bank stocks, the charts that I did want to share on the daily time frame, so maybe I'll go for those this weekend or later this week, get those out. But either way, this is an important level to watch. As you can see, we have quite a few reaction highs there, and this has just been a base, a consolidation range. You look at the volume of price histogram, very thin up here, very little volume. If we can punch above that level, and if we turn down, then this is the next support level, this horizontal line here, and if we were to go below there. So not much I can say on this chart. I'll say neutral. The trend has obviously been strong. Current price action is bullish, but we are coming up on a key resistance level, and these stocks are getting extended. So all in all, if I were long the sector, which I am not, I would suggest either taking some profits or tightening up stops on those positions. And I definitely wouldn't be an aggressive buyer of financials here, as extended as they are coming up on key resistance. EEM, symmetrical triangle breakout, and retest here. Obviously bullish, no other way to spin that. Here's a horizontal resistance level, pretty significant level in my opinion. Quite a few reactions defining this level, and that is not far overhead, as you can see there. So that would be 45. FXI is China, one of the Chinese ETFs, tracks 25 of the largest, large companies in China. It's not representative of the SSC, the Chinese mainland index, but been doing well lately, coming up to a nice resistance level here, the old 38.2 fib of the move down, and some nice reactions here. So FXI is getting a little extended, and I would consider taking some profits if you have been long that one. PBE, Biotech Portfolio ETF. This one is a short on the site, at least through the IBB is what I'm using as a short vehicle on that. And I've covered that one quite extensively. Negative divergences in place. You look at the orange, we have this rising wedge with these orange lines here. Very impulsive, clean breakdown, and nothing but a retest at this time. And again, taking all of it into consideration, I do think prices on this one will turn down soon and continue lower. TNX 10-year, these are 10-year government bond yields. Bullish falling wedge. I mean, very clear pattern. Look at that. Strong divergences. So, it seems like we're going to have interest rates moving higher here and bonds down. MU, this is the agricultural ETF, a nice downtrend line going back all the way to 2010, early 2011 I should say, and a recent breakout there. So overall that one looks bullish as long as it remains above this line. Wouldn't be surprised to see it come back in and retest, but either way, looking overall bullish with that breakout. PGJ, another Chinese ETF, that's a nice clean falling wedge pattern, and negative divergence in place below, and a pretty clean breakout. Keep an eye on this 40-week moving average, which is the 200-day moving average once again, because that has done an okay job as support and resistance, and it has been resistance lately, and we're challenging that line now, or that level, and so overall looking a little bullish there. S&P 500, did say I'd talk on this one. We're coming back, as I mentioned, we're right at retesting this key primary uptrend line. The week isn't over yet. So far, we've had a couple closes right on or around it. So, if we power up high, tomorrow's Friday, if we close that week way up in here, that has really put a damper into the bearish case. As I talked a lot, it doesn't completely rule it out. I have, some additional upside levels that we can go to on this move and still keep the longer term bearish case intact, but I would like to see a reversal tomorrow, ideally, to keep this bearish scenario well and alive. I'd like to see the S&P come in tomorrow and close on or near, ideally below this uptrend line. XEX, the oil and gas spider ETF, this one, keep an eye on this downtrend line. We're very close for a breakout here. If we fall back here, this would be your support level, key support level. So there's a triangle pattern, and like a lot of things, it's getting close. It's got a little ways to go before apex, but one to watch. And the Russell, talked quite a bit about this. Here's another downtrend line, and we've seen the breakout, and at this point, nothing but a retest. We still haven't taken out the previous highs, and like everything else, and most importantly, and I've covered a lot of sectors here, but in the broad markets, and that's what you want to look at, are these long-standing negative divergences in place. And so no matter what happens here, especially in the month of December, a very low volume trading month, I think January is going to define where we go, and will quite likely define what happens in 2013. If we turn back down, take out these recent lows in the markets, I do believe we're going much lower, and we're looking at a bear market in 2013. However, if we can take out these recent highs and burn through these divergences, then the market may have some more legs. We may extend this bull market. That's it, folks. Hope you enjoyed the video. This has been Randy Finney with Right Side of the Chart.